The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources podcast. If you're enjoying these podcasts, feel free to hit that subscribe button to make sure you always get the latest release. And if you have any friends or family, coworkers, anyone you think might enjoy hearing these or benefit from hearing these, feel free to forward that link on to them. We'd appreciate that. Thank you.
So anytime anybody's doing a podcast, there's always prep time. And so we're talking about what we're going to cover today in this podcast. And the objective is to add information to your knowledge base. And the easiest way to do that is to tell a story. And in fact, that is the easiest way to sell a product. And that's what Wall Street does. And they're no different than anybody else. When you think of the ads that you see on television or the Super Bowl, those are big deals. What are they doing? They aren't just saying, go buy my stuff. They're telling a story that should have some emotional impact that makes you want to go buy their stuff. Because if it was simple, you just go buy it anyway because you know you wanted it and you needed it. But they're trying to sell you something that maybe you don't have. And that's Wall Street works the same way that car lots do. But there is a difference. And when I was in college, I worked on a car lot for a summer selling cars. So I do understand a little bit about the system in the old days. I think it's a little more sophisticated now. I've noticed that when I buy cars, and not frequently, but the process is a little smoother than it used to be. But you walk onto a car lot, you know what the rules are. You put your hand on your pocketbook because they want to convert your cash into their commission. You're looking for something specific because you know what you want. They don't know what you want, but they want to sell you something. So you have your guard up. And Perry, you're nodding your head. You know exactly what I'm talking about.
Absolutely. And it's a shame that's not the same way you feel when you go see someone from Wall Street or anybody in finance who's selling you something. They really are not there to take care of you. They're there to sell a product. And they are some of them are very, very good at it. They've got great stories to tell you about how great you're going to feel as soon as you make that purchase, and that's all they're there for. We don't see it in writing a lot, but we have read it before where it was somebody was writing, making sure that everybody understood. It was from a stockbroker at a broker dealer, so one of the larger firms, saying you need to remember that a brokerage firm's job is to raise money for Fortune 500 companies. That's what they exist for. They're there to sell those stocks because Fortune 500 companies need them sold. They don't care who they sell them to. They don't care if it's the best idea for you. They just know they got to move that stuff, and they're going to do it. And if you'll help them, they're going to buy you an extra cup of coffee while you're sitting across their beautiful desk, as long as you're doing business.
Probably have some cookies to go along with it.
Might even have a cookie, sure.
And if you're not in the mood to buy something, they get really worried because overhead runs. I mean, everybody who's working on Wall Street wants to take a paycheck home, and if they're not selling stuff, they're not getting paid.
Right.
Whether it's commissions, fees, or bonuses, the cash flow works because as a retail investor, you're showing up with something out of your pocketbook that you want invested for the future. And an example of creating something for the moment is what happened after the great financial crisis in 08 and 09 when the market collapsed. It was down 34% in a relatively short period of time. And particularly 401k investors quit putting money into the market. They were scared. Everybody was scared. What's going on here? Now, this is just simply not normal. Interest rates have changed. The housing market has imploded, and real estate, particularly our own homes, were considered to be storehouses of wealth, and yet they had collapsed 50%, in some cases more. That was a scary period of time. So people quit putting money into the market. And for 401k plans, that regular monthly deposit in there is a steady stream of income for Wall Street. The net result is that Wall Street said, we have to do something here. So they do some surveys and find out what people are afraid about. And basically it was generally, I don't know anything about the market, and I certainly don't know how to invest, and I really don't know how to do anything right now with the market have fallen 34%. I mean, people were throwing up their hands
Now
in
what?
fear.
Yeah, sure.
And you're right. Now what? Now what do I do? So Wall Street said, well, we have an answer. We'll take care of the asset allocation problem. And they created target date funds. They basically said, if you're going to invest, if you're going to retire in 2050, then this would be the allocation that you should have now. If you're going to invest in 2040, this would be the allocation. We just created a series of mutual funds for different target date retirements, and we will take care of the allocation along the way. And people said, well, that feels pretty good. I don't have to make decisions, and Wall Street, they're professionals, they'll take care of it for me. And people started putting money back in the market. So that narrative of don't you worry about it, let the pros worry about it, worked. It got money flowing back into Wall Street. And virtually every major mutual fund company created a series of target date funds. And after, I don't know whether it was 6, 7, 8, 10 years, the exchange traded fund sponsors figured out that, hey, this is a good narrative. This story sells, so we need ETFs to do the same thing. And there's nothing wrong with them in concept, but there is a big difference between fund families and what they charge you for what they do. Now, we run some 401k plans for companies in the local area, and we're responsible for fund selection, which includes target date funds. We run models which will invest in target date funds when they're doing particularly well. But if they aren't doing well, our models don't use target date funds. So there's two ways to approach this. One of which is I want to sit back in my recliner and let Wall Street take care of it. And presumably that has less risk. But what we found out is 401k managers with a fiduciary duty to the plan and the trustees is that not all target date funds are the same. First of all, there's no standard in the industry for what a target date fund at any given date is supposed to look like. Now,
and there's no rush to get a standard either. It's like everybody's fine with that because it pretty much allows them to do whatever they want to inside that fund. There's nothing they have to do. Something that's for someone who's already in retirement doesn't necessarily carry significantly less risk than someone who's 30 years old and supposedly has decades to retire. But that's what Don, you just illustrated. That's one of the biggest dangers of the narrative. The narrative is not always connected to reality. Here's what's supposed to be happening, but in practice, that might not be exactly the execution you're going to get, which is why it's like everything else. It's buyer beware. You have to look under the hood. You have to make sure you're getting what it is you think you're getting, because Wall Street's not always going to tell you exactly what it is that they're up to. Because especially after the sale, they're going to tell you everything's okay no matter what. Because again, that's their job, to keep your money invested once they get it.
One of the other assumptions that is a narrative regarding target date funds is that the shorter term funds have less risk. If you're going to retire in 2030, you would assume your portfolio has less risk than if you were going to retire in 2050.
Right.
That's reasonable. Well, reasonable and reality, they both start with R, but they have different outcomes. So,
correct.
Because we do this work as a fiduciary to protect the trustees so they have responsible fund menus, what we do is we track the actual performance on how well funds stay aligned with risk exposure. And what we have found is that some target date funds are basically just pockets of trading money for the manager. We'll
Right.
find that the 2040 fund is more aggressive than the 2060 fund at certain times of the year or in certain economic environments, and vice versa. What should happen when you do a risk analysis is that they should align. Your near-term fund should have the lowest risk and the lowest current return. And as you get further out in the spectrum of time, it should become a higher return scenario. Now,
Right.
if the market's falling apart, then you would expect the near-term target date to be the most defensive. And that's not always the case.
Doesn't happen that way. Right.
That's one of the variables that's in the narrative. Don't worry about it. We'll take care of it from Wall Street versus the way things actually work. The other issue that's in the narrative is that you don't have to worry about this. We're a big company. We know what we're doing. We'll take care of it for a really big fee.
There you go.
Well, the fees range widely. We use the Schwab family because they are extremely low fee funds across the board.
Correct.
When Charles Schwab a number of years ago basically said, "Hey, this business is a fee competitive business, and we need assets under management, and we are going." And Charles Schwab said, "We are committed to be the low fee fund sponsor." And every time somebody else has dropped their fees, if it impinged on Schwab's margin, they cut their fee. They would at least match it or undercut it again. And as a result, in our research, the Schwab target date funds are the least expensive in the industry that we have found.
Correct.
The difference is maybe you have an average fee. I'm going to round off some numbers here. Let's say we have an average fee of 5 basis points versus Fidelity at 75 basis points for what is supposed to be the same objective.
Correct.
Well, maybe you don't like Schwab and you like Fidelity as a name because when they do something else for you and you're willing to pay that. But typically, most people don't know they're paying the extra money. And that's kind of like walking onto a car lot. You don't really know what the profit margin is. Maybe you're in a lot that shows you the invoice they get from the Ford company or the GM company, but you don't.
Right.
But you don't know what the kickbacks are.
Right.
So that's part of a narrative to get you to say we're really giving you a good deal. You should, don't disrespect us here.
Right.
That kind of research doesn't happen with a retail investor in a 401k plan typically. Though every year on the plans we manage, we put out an analysis of the funds that are in there and what their costs are, what it actually costs the employees, so they know that they're not paying too much to get the benefits of being able to invest in their tax sheltered plan. But these narratives have all sorts of places that they're running. One is TikTok. I mean, that's been in the news a lot. How about the Trump coin or digital currencies? Every one of these has a narrative. Basically, people are trying to figure out what's going on and convince you should go with them for the outcome that they expect. But the bottom line is, as we say all the time, nobody knows the future.
Nobody knows anything, and they're going to tell you they do. That's important to know. They're going to tell you, we know the outcome here, and we know what's going to protect your money in the future. You just have to go with us. Anytime you hear that, run the other way. It's a sales pitch. They're just trying to sell you something, and it doesn't matter how compelling the story is or how emotional they get, trying to get you to follow them with your dollars. And unless they have some cold, hard data, here are some numbers about our returns and our costs. If they're not talking about that, then that's because they don't want to. And that should be a giant red flag. do not allow yourself to get pushed around by the narratives. And it's very easy. It's psychologically very seductive to say, yeah, that really sounds like a great story. I'm going to go do that. And it's very satisfying emotionally for the investor. It can also be completely wrong. And that's very dangerous for your portfolio. And that's what investing is all about.
So it's what we just described is the reason that independently, before we were working together, we left the brokerage business because the conflicts of interest in the brokerage business, the financial planning business, are many. Yeah, there are advisors who will take time to disclose those, but not everybody does.
Right.
But we operate as a fee-only registered investment advisor as fiduciaries in every client engagement. If we have a conflict of interest, we disclose it and explain how we are handling it. But we manage our own money in a way to minimize the potential conflicts. And we run the business in the same way. Minimize any potential conflict. Try to just don't get in a situation where it exists. Anyway, if this makes sense to you, it probably makes sense to some of your friends, family, or coworkers. We'd appreciate it if you'd pass the link on. If you haven't already, subscribe to our podcast. You want to know what we think about the market trend. We do a monthly stock market webinar on the first Saturday of the month. Go to our website and register. You'll be notified how to register once you request that on our website. The shortcut to the website is iriradio.com. Thanks for listening. Remember to subscribe. The button's down below there. And we'll be back on another day with another subject.